Alright, MegaWhale team, welcome back to our channel, guys. Thanks for tuning into today's video. We have a good video today, a lot to talk about. FOMC, macro, the bottom, could we go lower? So many questions, and we've got the answers. So let's go ahead and get into it. Before we get started though, head to the pinned comment below, click the link specifically to our Telegram channel to get access to all of our updates, analysis, videos, and much more information in here. Let's get into it. So first and foremost, guys, we talked about this a few days ago. And this is a chart here showing us what people expect the FOMC interest rate hike to be, whether it be 0.5, 0.75, and 1. This was taken over 4 days, so we had post-CPI, pre-CPI, September, and August. And as you can see, post-CPI, which was a few days ago, their odds of a 1% rate hike was around 40%. And the majority was expecting a 75 and almost no one, so 0% expecting 50. That has since changed a little bit. We can see now that the rate hike potential to see 1% has dropped from 40 to 18%. So fewer and fewer people are now expecting that to come to 100. More and more people are expecting to be lower, about 75. Okay, so 50 to 75, more and more people are expecting, less people are expecting 1%. So something interesting to keep in mind, because this is going to really play a massive impact on how the market moves moving into October. We're going to talk about all of that in just a second. So first and foremost, Bitcoin was still pushing sideways. This entire range here has been volatile, but we've been more or less in a sideways consolidation since June, since that bottom hit all the way back in June. We're going to talk about this chart today, talk about where we can see the price heading. We're going to talk about our short term. We're going to discuss Bitcoin dominance. We'll talk about the DXY. And finally, we've got a few new indicators we're going to talk about on the macro chart that could potentially suggest the bottom is in. And if not, how low we can actually go. So let's get started. So we'll loop it back to the FOMC, and we talked about how we think that if 1% rate hike comes out, we do expect the price to crash. And that is true. If we see a 1% rate hike, we do expect this support zone over here, this gray zone here, to inevitably be lost. Okay, a 1% rate hike will massively push the price down. We already know that 1% the market has not priced in. That would be overly bearish. It would push up systematic risk. And we already know that rate hikes specifically are what actually moves the markets. That actually adjusts, or should I say changes, the risk in the market directly. So CPI is more or less an indication of what the rate hikes could potentially be. If CPI comes in better than the previous month and better than expected, generally we expect the probability that the rate hike decreases is to be higher. But if CPI comes in bad, which it didn't come in bad, but it came in higher than expected, there's a higher probability that the rate hike will be higher. So right now, more and more people are expecting 75, few people are expecting 100, and basically no one is expecting 50. So that's where we're currently standing. But if we came in at a 1% rate hike, if there's a 1% rate hike, that would of course be higher than the previous hike, which was 75, which was 75 basis points. And that would indicate that inflation is nowhere near topped out, and the market has a long way to go before we see any sort of macro recovery. That would really push the market down, as it would shift the entire sentiment from a sentiment being we're potentially topping out, we're potentially seeing a reversal here in the macro, to we have a lot more ground to go down. And we'll talk about that now. So where would we actually go, guys, if the rate hike came in at 1%? Well, to do that, we can take a look at a few things. What I really like to do is take up the VRPV. It really indicates, these high and low volume ranges where the price can easily move between. And we can see already that below this area of support, this area of support extends to the bottom, which was that low here of 17,600. Obviously, 17,600 provided a lot of support in this range as well. This is that support range. We can see that we have a huge gap over here, which takes us all the way down to about 12,000, 13,000. Okay, so if 1% rate hike comes in, there is a good probability that we clear this entire range and head down. There's a few things I want to talk about, and talk about why this would be unlikely in terms of the actual chart. We'd have to invalidate a few things. And I have to show you on the macro in a second. We'll kind of hang on to that point because we'll come and loop back to it later. But I want to go through a few things first here. So at the moment, we have a few structures. We have a few diagonals. First and foremost, we have our macro. And I'm going to go ahead and put it on a standard scale just so this this works out a little bit better. We have our macro descending trend line. All right, this is our macro descending trend line. We have a falling wedge structure, which we can draw like this, okay? And then of course, if we go ahead and copy this one over, we also have our second trend line, which lines up to about over here. Okay, so we have a few diagonal resistances on this chart, and obviously a lot of horizontal ranges. As you can see, we are nearing the end of this falling wedge. We're coming close to that downward diagonal resistance. If we had to see a price move to 13,000, it would have to happen within this range here. Okay, it would have to happen within this range here, which takes us to the 7th of October. If we are going to see a crash down to this range, it's going to happen within the next 4 weeks, potentially even sooner. That is the only possible time frame we have for this move down in accordance to the macro structure. Because if we break through this diagonal downward sloping resistance, that will give us the momentum to push upwards and retest this major rejection zone, therefore delaying the crash, therefore changing the market sentiment environment and potentially letting us run upwards into this range. So we don't have a lot of time left to see this crash. A lot of people think, oh, we got heaps of time. I personally don't think. I think we got 3 weeks at max to see a crash down to this range. Otherwise, I don't think we're going to see it, at least until the next potential hike. So keep that in mind, guys. This rate hike is more important than you probably think it is. It is incredibly important to predict the direction of the market. Let's talk about the upward move. If we get 75 or 50, and obviously 50 is going to be mega bullish. To put this straight out, 50 we'll see a mega pump. All right, we'll see a big old move back up to 24,000. If we get 75, we're a little bit more steady. I think 75 we'll see a bit of initial volatility, and then we'll see a little bit of a rise after. But for us actually getting any bullish momentum here, yes, we do need to break out of this downward trending resistance. We need to get over this volume clump here, push over 25,000, and that will take us directly up to about 28 to 30. As you can see, 28 to 30 is the next major horizontal resistance range. This range will act as a major ejection point. If we can push through, we push up to the next, so on and so forth. Okay, that is how it's going to play out. I would expect us to do something like that, come down, retest this level, push up, and then continue if it plays out. Okay, so provided that we get a good hike, a good interest rate hike, and it doesn't go up 1%, it goes 7.5, 0.5, we could potentially see a swing around in the market. And we'll come back and talk about why we think that's possible in a second, but I want to go to the short term really quickly. And we talked about this chart the other day, and we told you there's a few things we want to look out for. And for the short term, it's a little bit different, because here's the thing, guys. I do expect volatility leading up to FOMC. I do think we could potentially go lower here to FOMC, but the interest rate hike is going to be the thing that triggers the market to move in the direction that it should take. So I think between now and then, no matter what happens in the price, provided we don't make a brand new low, I don't think is very telling on where we think the macro price is going to go. I think it's best to wait and see what happens. I don't think taking massive positions here is ideal, but purely because we're going to talk about it, we may as well talk about the short term. And it's nice to see we're pushed back above this horizontal, this diagonal resistance over here. As you can see, this diagonal resistance was the basis of this pennant formation, which we actually crashed down to, made a low, and pushed back upwards. We're pushed back above it. We've retested support. It'd be really nice to see that 50 moving average break above and potentially push into this range. This 20,600, 20,800 range is the trigger point or a major rejection point for a move back up to about 21,800. 21,800 is that major resistance point we were talking about a few videos back, which acted as a massive resistance all the way in June and most of July, as well as in late August. And this point here is the major trigger that sends us up to 24,000, which, if you remember, 24,000 is this upper resistance zone that we do need to break to actually get the bullish momentum. So I think it's very unlikely that we do in fact break above 21,800 before FOMC. I think if we get even bullish price action now, everything is amazing. I don't think we break over 21,800. I think best case scenario before FOMC, we maybe push into 25,000, 26,000, 28,000 best case scenario, and obviously worst case scenario we can head back down just above 18,500 range, maybe mess around a little bit down here again, before we make another price direction or the market sentiment shifts. Okay. Bitcoin dominance, of course, has hit a major rejection point, which is very interesting. As you can see, this red area here has acted as major resistance over the last, well, long time, of course, this 41% range. And of course, Bitcoin dominance is telling us how much money is in Bitcoin, how much market capitalization is in Bitcoin in comparison to the rest of the cryptocurrencies. It's currently sitting around 40.86%. If Bitcoin dominance drops, altcoins will rally. If Bitcoin dominance pumps, altcoins get left in the dust. Okay, so what we're looking here, descending wedge. All right, we had a massive fake out over here, but of course descending wedges are bullish. We can expect to push upwards. If we do, however, lose this red line here, this trend line, there is a chance we head lower. If that happens, altcoins will see massive rallies across the board. If that happens while Bitcoin breaks out of that massive falling wedge, we can expect altcoins to pump massively. I think it's unlikely to see that, but it is definitely a possibility. DXY is looking more and more like it has reached the top. An ascending, rising channel here, or a rising channel, whatever you want to call it, is a bearish reversal pattern. It is similar to what you would say a descending channel is. If you flip it, you can see that we are nearing the bottom or nearing the top on this one over here. A lot of resistance at this 111, 110 range. And obviously losing this trigger, losing this 109.29 will send us back downwards to a 50 moving average or to 108. If we lose this trend line, we head back down to 103. Very much by that case, the market will be massively on a recovery, on an uptrend. I think it's very unlikely that we see the DXY continue much higher. I think we might see a little pump, but I don't think we see anything, you know, all the way up much higher. I think it's unlikely. It's possible, but it is unlikely. Of course, the DXY doesn't move based on technicals. It moves based on a lot of external factors. So doing a technical analysis is not the best idea, but it can give you some kind of understanding of the restraints of the moves that are occurring at this particular point in time. So very interesting. Let's get to the macro. So talked a lot about everything else already. I hope everything made sense so far. And as you can kind of understand by the vibe of the video, the FOMC interest rate hike is going to be the telling thing. It's going to be the most important thing for the market. More specifically, because we have such a short window that we can crash in back down to this range before we start breaking that downward resistance. And obviously, we talked already, if we break that downward resistance, that flips a lot of things in the market. But let's go ahead and do a technical analysis. And first and foremost, this is our Bitcoin macro chart for the new viewers on the channel. I want to go ahead and hide that for a second. You can see a few things over here. We have our absolute bottom, which is indicated by this lower resistance line. This area between these two lines here, and my drawing tool is not very good, is what you would call the bear market bottom. So not the absolute bottom, but it's like the bear market bottom range. This is kind of where we expect the worst kind of price action to be. Everything's dropping absolutely low, everything's bleeding out, some sideways volatility. This is where we expect it to happen within this range. This is the bear market. This is kind of where we start seeing prices tumble down. This is where we start seeing the prices lose momentum. We start seeing altcoins drop off, Bitcoin losing a lot of steam. This is the majority of the bear market, and then the big crashes come within this range. This is the bull market top. Okay, this is where we expect the bull market to top out. This is where we usually see altcoins go parabolic. And then of course, this range here is our blow off top range, where we just see an absolute parabolic explosion upwards that lasts not too long, maybe a week, maybe 2 weeks, 3 weeks at max. We're seeing that in every cycle except the last cycle. We didn't see that actually occur. We just topped out in that bull market range. As you can see, these yellow circles indicate points of retest. This is retest and rejection of that bull market range. Sorry, it's actually over here. And that triggers that rejection point of that bull market range that actually tumbles us downwards into a bear market. As you can see, every single time we've actually ended up again retesting this downward or this upward sloping resistance. And of course, we predicted this well far in advance. If you can go to my Twitter, you can take a look. So the question is, well, I guess a statement should we say is, why is this why is this time any different? And in reality, it's not. It's really not any different. The only difference is the potential economic threat that is burdening, I'm saying burdening the cryptocurrency market. And we talked about this at the start. We said the rate hike is a telling factor. And the reason that what rate hike is even more important this time around is because of the position that Bitcoin is in. And something is happening on the chart here that we don't see often. And that is a discrepancy between the RSI on the 2-week and the bottom retest that we've seen on the macro trend line. Let's take a look. Bottom retest here. Okay, let me actually, make it easier. I'm going to draw a horizontal. This is the bottom retest right there. The bottom retest. This is a trend line retest. Okay, the bottom on the RSI happens here and here. You can see that we have a bullish divergence. We have a, we had a bullish divergence over here, okay? But we have a discrepancy between the prices in terms of where the price is when it touches and where the price is when the RSI hits that low point, okay? Now this time around it's a little different because the RSI has hit a potential low point at the same time as the price reaching this macro uptrending line. And it poses a question. Is this the time the trend breaks? Is this where the trend fails? But this is something we haven't seen before. It'd be very, very nice to see this price move upwards, this RSI move upwards, retest and continue upwards here. That would match the trend. And obviously, we're going to show you a few things in a second that could potentially suggest that actually occurring very soon. That is something to keep an eye on, of course. The RSI is potentially signaling that the bottom is in, but it's also showing us something we haven't seen happen before with the RSI on the 2-week. That is a area of, I would say, uncertainty and discrepancy in the trend, which obviously is never a good thing. Let's go to the larger time frame, and we're on the weekly chart over here, and we can see just as we had that falling wedge on the Bitcoin chart, we also have that falling wedge here on the weekly RSI. And the reason why I have this area indicated outwards is this was in fact a fake out retest upwards, a false high. The high was not in November, it was all the way back here in April. So this is our falling wedge formation, and you can see it is a valid falling wedge. We have at least 3 retests on one side and at least 2 retests on another, so it's valid. And like I said before, if you remember back to that chart we'll show in a second, we don't have a lot of time before the price reaches the end of our descending wedge, which is here, this range, and on the weekly, the end of our falling wedge on the RSI. So something has to break here. Either we crash downwards with FOMC and we go to that $12,000-13,000 range and we see a violent, drop down on the RSI, as well as a violent drop down with the price, okay? Or we see the opposite. We see the RSI break, we see our trigger point break, that 40 level on the RSI of a trigger, and we continue upwards, flipping the RSI on the 2-week, printing that bottom confirmation that we were looking for, and breaking that downward resistance, sending us upwards into that next horizontal range, flipping the momentum, flipping the trend, flipping the bear market. That is it, guys. I hope you enjoyed the video. If you got any questions, leave them down below. If you want to trade while I trade or support the channel, click the link and sign up to Bitget, the best exchange you can trade on. You'll find more information about that one in a second if you're interested. And of course, see you guys tomorrow. Okay guys, we're going to be taking a quick look at Bitget, and now Bitget is where I personally trade. I highly recommend signing up to Bitget with the link down below. Bitget is probably the best exchange out there if you are a trader. It has a variety of features, and the best things about Bitget are a few things. Number one, it's non-KYC. Well, KYC is completely optional on Bitget. Now, there's a whole variety of exchanges out there nowadays that have gone completely centralized, sharing your personal trading information and information of decentralized governments and different governing bodies. Bitget allows that option to be left to the individual, to the user of the exchange. You can decide to non-KYC, you can decide to KYC. It's completely your choice. Another really beneficial thing about Bitget, and the biggest reasons why I'm sitting here actually recommending Bitget to all my followers, is that it has 0.02% trading fees. All right, this is significantly lower than any other cryptocurrency trading exchange out there. FTX, Binance, could name a bunch more, KuCoin. It is significantly lower, by 500% lower than the lowest exchange out there, Binance. Another big thing, guys, is there's no global restrictions on who can use Bitget. Anyone from anywhere can sign up to Bitget and get access to the entire exchange of all the tools, whether it be futures or spot. No matter which country you're in, you can use futures and spot. If you're in America, for say, and you want to get access to more spot trading pairs, such as Binance Global, and you can't sign up. Well, guess what? They've got 250 different spot trading pairs here on Bitget to get access to, and you can get access to all of these. If you're in Australia and you want to access the futures market and you can't trade futures, you can do it here on Bitget. You can get access to the future market and start trading with leverage. And finally, guys, if you do want to sign up to Bitget, go ahead, click that link down below to sign up to Bitget, and you'll get access to the reward center over here, which enables up to $4,000 in rewards by completing 5 tasks. All right, guys, we'll get back to the video. Thanks for listening to that. Okay, guys, I want to take a quick moment to introduce the Become a Trader course at the end of this video. This course was designed by myself and Wolves of Crypto. We put together a whole variety of knowledge to create the most cohesive, understandable, and beneficial trading course there is on the market. If you're interested in learning how to become a trader, if you're interested in learning how to use technical analysis, if you're interested in learning how to apply market analysis to different cryptocurrencies, this is a course for you. We teach you everything from the fundamentals, the basics about what cryptocurrency is, how to trade cryptocurrency, mastering the craft of cryptocurrency, diving into a whole range of technical indicators, market structures, and teaching you how to utilize these when finding trades and applying risk management strategies to become more profitable over time. We even dive into market psychology, human psychology, and provide a variety of different videos and educational content, including courses and quizzes to assist your learning along the way. If this is something you're interested in, guys, go ahead and contact us down below at the cryptoacademycourses@gmail.com. We'll send you an email back with all the course information, the structure, the payment details, and everything else you need to know. That being said, guys, I hope you enjoyed the video today, and we'll catch you in the next one.